Now that said, last Tuesday, 2 days ago rather, we're looking at I think we're looking at intra-group transactions. We looked at intra-group trade where it involved inventory that remained unsold or that remains unsold as at the date of consolidation. And then we looked at intra-group sales of non-current assets. And we looked at how that can be adjusted for the case of extra depreciation and whatnot. But today we are looking at an acquisition that was made during the year. So in our building of blocks, in the building blocks of things that we have been looking at, you notice that we have been increasing the complexity of the things that we are discussing in class. Now, the assumption the whole time, or the questions or problems that we have solved this whole time have been cases where we have imagined that the acquisitions were done at the beginning of the period, all right? Now, what if the acquisition was done in between or during the year, all right? So it's simply the idea that should come to your mind should be that, oh, if we consolidate during the year, then it simply means that there will be a portion of profit in that accounting year that we will not have privilege to, all right? You know, we've always been talking about pre-acquisition retained earnings. Let me slow it down. We've been talking about pre-acquisition retained earnings. And what we have said about pre-acquisition retained earnings is that the new parent or the acquirer will not have any share here. Instead, we will cancel out the pre-acquisition retained earnings as part of the net asset that was acquired on the date of acquisition. When we are doing our calculation of goodwill, remember we always say the consideration, the NCI, we add it together, and then we'll knock that out against the net asset acquired. And I always say, when you get here, the retained earnings you will put here after ordinary share capital of the subsidiary, the retained earnings of the subsidiary that you are going to recognize in the calculation of the goodwill on consolidation should be the pre-acquisition retained earnings. All right. Now, if that has been done and all our assumption has been that the acquisition was done at the beginning of the year, so what could change or what could possibly be the different thing that could possibly happen if we did not acquire at the beginning of the accounting year, but we acquired during the accounting year, in the middle or somewhere in between? So what would have happened is that part of this pre-acquisition retained earnings, there will be profit. There will be a portion of profit for the year that is part of this pre-acquisition retained earnings. So it is for you to do what is called due diligence to ensure that when you are doing your SOPL consolidation, you will not share part of the profit of the year that is part of pre-acquisition retained earnings. So therefore, since we are not doing SOPL, we are doing SOFP, Statement of Financial Position. When it comes to the consolidated statement of financial position, that adjustment, I have to be very careful when I am treating the group retained earnings. I have to be very careful there. All right. Okay. Now we are going to look at it. Let's look at it together. It does not hold so much water until we demonstrate. No matter how much I explain it, if we don't demonstrate it with a solution, you may not understand very well. So to drive home everything I've tried to say, let's look at an actual question. All right. Okay. We're told PICO acquired 80% of the shares of ESCO on 1st April 2017. All right. On 31st December 2016, ESCO's account showed a share premium account of 2,000 Naira and retained earnings of 7,500. A statement of financial position of the two companies on 31st December 2017 are given below. NCI should be valued at full value. Now we're told the market price of the subsidiary's shares was 3 Naira prior to the acquisition by the parent. Then we're given the statement of financial position as of 31st December 2017. All right. And then we're told to prepare consolidated statement of financial position of PICO at 31st December 2017. All right. I want to solve. Okay. What is notable for us here? So let's learn to quickly begin to note out certain things. The first thing to note out is what is the holding? It's 80%. All right. What is the date of acquisition? It was 1st April 2017. All right. And we're told that since December 2016, they had a share premium account of 2,000 Naira. This is part of their net assets that must have been acquired. The same thing with the retained earnings that had existed since that time. All right. Okay. But mind you, there must have been some growth in the retained earnings. They specifically told you these two amounts were amounts that we had as at 31st December 2016. Okay. Now, they were told they had a retained earning as of this day of 7.5. All right. And then they had a share premium account of 2,000 Naira as of this date. So a very smart student to do this. You say, let me go and check. Let me go and check in the current year. They gave me an account, SOFP, for December 31st, 2017. In this current year, has there been some level of growth in the share premium? No, there has been no growth in the share premium, meaning I'm going to cancel out all of this without any issue when I'm dealing with goodwill on consolidation. But when I come here, I have 19.5, okay? Now there has been some growth in my retained earnings. As at December 31st, 2017, there has been a growth in the retained earnings. The retained earning balance is now 19,500. What does this tell me? Very simple. All things being equal, they must have made a profit for the year to the tune of how much? They must have made a profit for the year to the tune of that 19.5 minus 7.5. And that will give me 12,000 Naira. Okay? Now, this is the profit for the year. But mind you, be careful. The date we acquired is a day that is in between this record of 31st December 2016 and this record of 31st December 2017. We acquired April 1. All right? Now, this 12,000 is a profit for the year. It means it's a profit that they must have accrued from 1st January 2017 down to 31st December 2017. Now, some of this 12,000, what we are really saying here is this, that a portion of this 12,000 would have been accrued between 1st January to 31st March, before the parents now acquire the company. This one, if the date of acquisition is April 1, all right, and you have given me retained earnings as at 31st December 2016, there will still be a portion of this profit for the year, exactly between January 1 to 31st March, that should be referred to as pre-acquisition, because those profits came before I acquired the company, before PICO acquired ESCO. So therefore, the pre-acquisition retained earnings is not 7.5. It must have grown. So what am I going to do? They did not give me any basis for me to divide this 12,000 to 3 months. So I will say, since they didn't give me, I will say, I am looking for 3 months out of 12 multiplied by the profit for the year, which is 12,000. And this gives me 3,000. It means that this 3,000, I will need to add it to the 7.5. That will make up what is called the pre-acquisition retained earnings. The pre-acquisition retained earnings. So it will form 10,500. Does anybody is there anybody that does not understand what we have done here? I want to believe it's straightforward, but I may be wrong. Is there anybody who does not understand what I have just explained now? All right.
Okay.
I didn't hear you.
Please explain it again. How we got the...
Okay, good. Mary, how we got what?
The pre-acquisition fee of 10,500.
Okay, good. Good. All right. The network.
Yes, sir.
Turn me off.
Yes, sir. We can hear you now.
All right.
You do not have stamina. Maybe stand well so that you not throw you off again.
I'll try my best. All right. Okay. All right. So what we are saying really is this. Mary, please stay with me. Just stay with me. Now you will notice that here they mentioned to us that PICO acquired. They said PICO acquired 1st April 2017. They now left that. They are now telling us the balance on the share premium account is 2,000 naira. Balance of retained earnings is 7.5. But this was as of 31st December 2016. I am now saying that come and check here. If you come and check as of this date, as of 31st December 2017, share premium account, the balance is still 2,000. It means that there have been no growth, right? There was nothing that increased. There was no movement in that balance, all right? Nothing increased the share premium account. However, our retained earnings, the meaning of retained earnings is that you had profits that you did not distribute to anybody. So you could have distributed your profits, but you chose not to distribute it. You retained it in the business, all right? So the major thing that causes growth or movement in the retained earning should be profit and any adjustment to prior year profits. Do you understand? Any adjustment to prior year P&L and the current year profit. Those are the only things that I am expecting to see to cause a movement in the retained earnings. So therefore, I now said, if there has now been a movement from 7.5 to 19.5, then it means that for year 2017, which is 1st January to 31st December, we must have had a profit of 12,000 naira. All right. Now, we had a profit of 12,000 naira. It is that 12,000 naira profit that caused us to increase our retained earnings to 19,500. Perfect. Good. Now, when we come back to the date of acquisition, which is 1st April 2017, we will realize that 1st April 2017 is a day inside this year between January 1st to 31st December, where we accrued profit of 12,000 naira. So I am now saying that if I want to calculate my pre-acquisition retained earnings, the simple analysis to do is to say my retained earnings as of 31st of 2016 is 7,500. All right. But the date of acquisition is April 1, 2017, meaning that I still need to calculate what is the profit that we got between 1st January to 31st March 2017. So because this date, this period, is still a period that came before we acquired. All right. And now said to do that, you can count how many months make a year. They are 12 months, right? Now, between January 1st and 31st March, there are 3 months, January, February, March. Then I will do 3 out of 12 times all the profits for 12 months. And that should give me 3,000. It is that 3,000 I will now add to this, and that's how I will get 10,500. So, Mary, is it clear now? All right. If that is clear, you have more or less solved the question. But let's still go to it, and let's do a whiteboard where we're going to look at what we can do there to solve the question. Hold up 1 second. Let me just quickly add up to my, what is it called now? To my data, so I don't run out. Sorry, one second, please. Okay. So group structure first. I said people purchased ESCO. 80% is the holdings. We said pre-acquisition. Sorry. Pre-acquisition retained earnings. We said that should be as at, because the date of acquisition is April 1, 2017. So we say as at 31st 12, 2016. The amount was 75. Now, as at between 1/1/2017 to 31st March 2017, we said we should have 3/12 times. If I write 12,000, somebody can still say, where did we get the 12,000 from? So this is what I'll do. We'll factor in the growth by showing you the working. 19.5 minus 7.5. All right. And we said that should give us 3,000. 10.5. Okay. Now, let me just quickly go to goodwill on consolidation. For goodwill on consolidation, I should have a consideration. Now, I've told you how to know this consideration. They may not mention it to you. So I said what you should do is go to the statement of financial position. So can somebody tell me how much did PICO pay? How much did PICO pay to acquire ESCO on 1st April 2017? I want a member of the class to please tell me. Are we still together? Mr. Latif, are you in the class? Or am I
We are
alone?
together. I'm trying to open the question, yes, sir.
Okay. Any other member of the class can go ahead. Let me find my, okay. What did you say?
25,000.
25,000. Were my people shy to say 25,000 before? 25,000. All right. And then we come to NCI. Now, to do NCI, I really must ask myself, what is the policy? The policy, according to the question, if you go to the question, you saw that they mentioned that we should value at
Your voice is cracking. We can't hear you.
the full value, and they gave me price, the market price. And is my voice still cracking?
Just came back to life now.
Okay, I'll change position. Don't worry. If the position where you will hear me loud and clear is on top of the tree, I'll go there. All right. Don't worry. I'll just change position. Now let's come back to the NCI. So for our NCI, we were told we have to treat it at full value. And they told us that ESCO's share price in the market is equal to 3 naira per share. All right. So how many number of shares is what we should now look for? Okay. Let me go back to the question. Now, if you look at where we made that investment, the line that says investment in 8,000 ordinary shares of 50 kobo each. Is it 8,000 that is supposed to be there? 8,000 shares. All right. 8,000 shares.
Out of 10,000 shares.
What did you say? Those
I said 8,000 out of 10,000.
how did you know it's 8,000? 80%. Good. Now, those 8,000.
We can't hear you, sir.
Hey, Jesus. You can't hear me.
Until you just said, hey, Jesus, and your voice came back.
Hey, Jesus. All right. How about now? Is it better now?
Yes, sir.
Okay. So what I was saying was this, that if people bought 8,000 shares and those 8,000 shares is 80%, then what is the number of shares that is 100%? All right. I can cross multiply. Now, 8,000, 100% is the same thing as 1, Abi? And 80% is the same thing as 0.8x, Abi? Therefore, x equals 8,000 divided by 0.8. And that will give me 10,000 shares. Now, NCI should be 20% times 10,000 shares. And that should give me 2,000. 20,000 or 2,000?
2,000.
Is this clear to every one of us? Hello, sir. Hello, man. Is this clear to us?
Clear.
All right. So those 2,000 shares are to be valued at 3 naira per share. So 2,000 shares times 3 naira. That's how we'll get 6,000 naira. Okay. So yeah, I can come here and say NCI is 6,000. NCI is 6,000 and this will give me 31,000. All right. Now, net asset acquired. Net asset acquired. Ordinary share capital, how much? Ordinary share capital, how much? For subsidiary.
$5,000.
5,000. All right. Oh, this space will not be enough for me. Can I erase? Or let me extend it here. Okay, 5,000. Share premium is 2,000. Pre-acquisition retained earnings. Pre-acquisition retained earnings is 10,500. All right. So if I add 5,000 plus 10,500 plus 2,000, that should give me 17,500. If you take this away, 31,000 minus 17,500, what do you get? I think that's 13,500. So the goodwill, on consolidation is 13,500. Is this clear? Nobody's answering me. Is this clear? Is my audio still bad? Let me.
So we can hear you.
We are with you, sir.
How do I know you are with me when you are not responding? All right, I understand it's late. Maybe some people are already even sleeping. I imagine that some people are in bed listening to this lecture. All right, okay. Now, after we have done this, the next thing to move on to is the group retained earnings. So permit me to simply just erase this one and quickly look at group retained earnings. Group retained earnings. All right. Now, how much do we have in the book of PICO? How much do we have in the book of ESCO?
20,000 PICO.
As of 31st December 2017, 20,000, 19,500. Abi?
Yes, sir.
All right. Pre-acquisition retained earnings. That one is 10,500. Now, if we take that away, we're left with 9,000. So far, the question did not mention anything about any adjustments. All right. So I'm just going to say share of profit, SOP, 80% of 9,000. And that should give me 7,200. And this gives me 27,200. As for my NCI, as at the date of acquisition, we valued NCI at 6,000. All right. I am simply going to add there 20% of the post-acquisition profit of 9,000. And that should give me 20% of 9,000 is 1,800. If I add that to 6,000, that should give me 7,800. All right. So what am I to note here? My goodwill is how much? Goodwill was how much?
Goodwill.
13,500.
All right. My group retained earnings, 27,200. And then NCI is 7,800. So I'm going to take this now to the solution so that we can see the numbers and consolidate there. All right. I'm just going to consolidate fully my PPE. My PPE is 31,000 by adding these two together. Now, this is going to be cancelled out. This was already cancelled out as a matter of fact. And what we have replacing it is goodwill. That goodwill we said was how much again? Sorry.
13,500. 13,500.
Thank you. Current assets, we're simply going to add these two together as well. Looks like 64,000. So current assets, 64,000. If I add this together, I would have how much?
64 plus
108,500.
108,500.
Thank you. Now, ordinary share capital. We said we'll pick only that of the parents. It is 50,000. Share premium. Okay. I'm sorry, you cannot share in this share premium. It was totally pre-acquisition. So the only share premium we have is this 35. I hope you understand what I'm saying. You have canceled out that 2,000 when you were doing your consolidation. All right. So the same way we canceled out the 7,500 is how we canceled out the 2,000. The only difference is that retained earnings, apart from that 7,500 and the eventual 3,000 we added, they still had profits. So we are now going to consolidate that profit, the percentage that belongs to the parent. But for share premium, that did not grow. All of it was pre-acquisition retained earnings. So that would have been cancelled out. So this is 35. In terms of my group retained earnings, we did a special working for this. And then we got 27,200. All right. If I add 50,000 plus
80,700.
Thank you. 80,700. My NCI was how much?
778.
7,800. And now this should give me 005. 88,500. Then my current liabilities will add it together. That's 20,000. That's how we get 108,500 here. So this is balanced now. It's as simple as that. Now, the only thing we want to teach you here, or the only thing that we wanted you to learn, the focus of this building block problem, was just to teach you that an acquisition can be made during the year. It is your duty to do due diligence to ensure that part of the profit for that year that came before the date of acquisition, you must be able to do the work to differentiate them. The one that came before the date of acquisition and the one that came afterwards. The parents can only share in the profits that come after the date of acquisition. The profits that came before the date of acquisition should be added to the previous retained earnings, and together we form the pre-acquisition retained earnings. All right. I'll erase all of this. So let's move on to the next question. Okay, in terms of solution, we did the same thing. Now let's look at fair value adjustments, right? This one also attempts to kind of bring everything together and see whether we can weather the storm. All right. We're told PICO acquired 80% of ESCO on the same 1st April 2017. Now, at that date, the fair value of ESCO's non-current assets was 11,000. Please go ahead.
Please let us see the heading of that question. It helps a lot.
All right. Fair value adjustment. Apologies for that. Okay, I'll move on. Start over again. PICO acquired 80% of the ordinary shares of ESCO on 1st April 2017. At that date, the fair value of ESCO's non-current assets was 11,500 greater than their carrying amount, and the balance of retained earnings was 10,500. The statement of financial position of the two companies on 31st March 2018 are given below. NCI should be valued at full value, which was deemed to be 18,000 naira at the acquisition date. All right. We're given a statement of financial position. They were told if ESCO had revalued its non-current assets on 1st April 2017, an addition of 1,500 would have been made to the depreciation charged for the year ended March 2018. Now it's beginning to look more like it. All right? Beginning to look more like it. All right. Good. I need to farabale so that I can understand what this question wants from me. So what I like to do as a student, not as a lecturer, as a student, when I was a student, what I like to do is to begin to imagine what my solution will look like. What are the key points? I have not started solving, but I'm just looking at implication of the things you have thrown at me. Implication number one, we have been told that the fair value of ESCO's non-current assets is 11,500 greater than their carrying amount. You see, in acquisition, this is normal. This is usually the case because the book value may not, at the point of the date of acquisition, the book value may not be reflecting the recoverable value or the realizable value of some of the assets and liabilities of the company. All right. So the major task that is first of all done before they can even arrive at what to be paid as consideration most times is usually a revaluation of the balances. A revaluation will be done. Now, when that revaluation is done, you will come to a point where you have things like this. So all you need to do is to say, if it is 11,500 greater than the carrying amount, then this 11,500 should form part of the pre-acquisition net assets of the subsidiary. It should form part of the net assets of the subsidiary. All right. Now, what I will do is this. My double entry will simply be to take this 11,500. It's going to increase my non-current assets. I'll debit non-current assets 11,500. All right. And then I'm going to credit. What am I going to credit? I'm going to use it to reduce the consideration that was paid. All right. So what account do we call that? We can call it the acquisition account, 11,500. What it means is that I'm going to use this to cancel out the consideration that was paid before I will come to the calculation. Before I will come to the result of my goodwill. Is it clear? This will be part of the net assets that was acquired. All right. Somebody will now say, what of the 1,500 that we are told that is the expected depreciation, additional depreciation? Now, if there's an additional depreciation, go ahead. Someone wanted to say something. All right, I'll move on.
It means that,
If there's
it means that the assets have been under depreciated.
Thank you very much. The assets must have been under depreciated. Now,
Yes, sir.
should that be the case, that this 11.5, it means we should remove 1,500 from the amount that is going to net asset acquired, right? I can do one simple thing. I will say, sorry. Additional depreciation is an expense, Abi. If it is an expense, I said whenever we are dealing with statement of financial position, what is representing anything P or L? Your retained earnings. Okay, good. So therefore, this should go and affect my group retained earnings. All right. And then I should credit it. I should credit it to my non-current assets. All right. Meaning that at the end of the day, my non-current assets will have
$21,500 plus 14,000.
11.5 minus 1 net increase with 10,000 would still have effect on my group retained earnings. Because,
hello,
go ahead, please.
That fair value adjustment, that
Yes.
asset that's not added at the beginning belongs to the subsidiary.
Okay.
And it is part of the asset acquired by the parent.
Okay.
Who is to bear that?
You.
Who is to bear that depreciation? Who will burn it? Is it the retained earnings of the parent also?
Okay. Not only, okay, good. Very good question. Very good question. Now, this asset is going to be part of what the parent company has acquired. So in my consolidation, I'm supposed to bring in these non-current assets, the increase in its value. All right. Now, that 1,500 depreciation is to the subsidiary, Abi. So I'm going to make that adjustment under subsidiary, and then it will now be splitted between the group retained earnings, the parent, and the NCI. Is this clear?
Well, it is, sir.
Go ahead.
No, I'm with you. I'm okay with you, sir.
All right. Okay. I think this is best. This is best done. This is best solved when I demonstrate. Maybe we'll now see whether you understand or not. Is it? I feel like the way I've explained it now, it may not be so clear to you because it may not be so apparent. This posting I have done here may not be so apparent even when I demonstrate it. But I will tell you in the implication of what I have done when I demonstrate it. Is it okay that way?
Yes, sir.
All right, let me move on. Okay. Now, another thing that you must note is that this question is not like the other question. The other question, the first question we saw, had the trickery of giving us the retained earnings as of December 2016, and then telling us that the date of acquisition was April 1st. For this one, they did not do any trickery. They told you that as at the date of acquisition, don't bother doing any special work. We have given you the retained earnings. The retained earnings as of that day was 10,500 as of that day. Happy? Except if I don't understand English. They say at the days the fair value of ESCO current asset was greater than this, blah, 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 blah. Retained earnings was 10,500. Okay? Now, what they have done again is to tell us that the statement of financial position of the company on 31st March 2018 is given below. Okay? Now, if they tell you that this is a statement of financial position as of this day, all right, you are to assume that it means that this is the date of accounting year. Now, if the date of accounting year end is 31st March, the simple thing I used to say is, if you end 31st March, it means you want to begin the next period April 1st. So that means that their accounting period must have spanned April 1, 2017 down to 31st March 2018. This is how they are going to count their full year for 12 months. All right? Now, what does that tell me? They acquired April 1, 2017. They did not acquire during the year. They acquired at the beginning of the year. Is this clear? Is this clear?
Yes, sir. Yes, sir.
Okay. Mary, is this clear? Alexa, is this clear? Aisha, is this clear?
Thank you.
It's okay. All right. Madam Aisha, is this clear?
Yeah, yes, it is.
All right. Okay, not to waste time, let's move on. Let's go to what else? I think that is that about that. We have really analyzed the question. We can go ahead and solve.
Yes, sir. We cannot hear you. Your voice don't run away.
Hey, how about now?
We can hear you now, sir.
Okay. Okay, now, fair value of consideration paid. I said we should look at the question and see what is PICO's investment in ESCO. According to the statement of financial position, we are told they invested 25,500. NCI, we're told, should be valued at 18,000 naira. That should give me 43, right? 1,500. Now, net assets acquired. Ordinary share capital. Ordinary share capital of the subsidiary is 10,000. All right. The pre is 10,500. All right. Was there any other reserve? No. But we have been told of fair value adjustments. Okay. We have been told that there was a fair value adjustment. How much? We're told 11,500. Okay. 11,500. So non-current assets. $11,500. And if I add this together, 10,500 plus 11,500, that's like 22,000 plus 10,000, that should be 32,000. You take that away, you're left with how much now? 11,500. All right? You are left with 11,500, and that is your goodwill on consolidation. Now let's come to the group retained earnings. Now here you must remember, you must be careful here, because you must remember that you have made an adjustment, that depreciation, all right? Now, PICO, ESCO. As of 31st March 2018, we were told, according to the question, retained earnings of PICO was 48,000, right? Whilst that of ESCO was 25. But we must be careful, because we cannot take part of the pre-acquisition profit of ESCO. So we need to take that out. What we had here was 10,500. This is the second leg for it. Sorry. Post-acquisition, retained earnings would therefore be an amount 10,000 naira. I now said you made a fair value adjustment. You should make a fair value adjustment of depreciation. The depreciation is how much? 1,500. Now pay attention to this. I am taking out that depreciation under ESCO. Now, what is the meaning of this? I have told you before, any adjustment that will affect both the parent and the NCI, you will take it out from the subsidiary line. I will do it here. I will not come and do it on PICO. If it affects PICO alone, all of that 1.5, I'll just bring it under PICO. The fact that I have already deducted this 1.5 from the profit of ESCO, it means that I have deducted it from what I am going to be sharing to PICO and NCI. And that way, I have shared that depreciation amongst the two of them already. The second way I could have done it is to share 10,000. However, I will now determine 80% of 1.5. 20% of 1.5, I'll deduct that from the profit I will share to NCI. And that is the way I will go about it. But it's best to do it like this so that you don't have to bother. So SOP, share is 80%. Sorry.
6,800.
Times 85. 6,000. Is it 800?
Yes, sir.
So what we have here is 54.
800.
800. Okay.
Okay.
As for NCI, not so hard. I'm just going to take that 18,000 value as of the date of acquisition and do 20% of 85. Add that to 18,000. 20% of 85 should be like 17. All right.
Yes,
1,700 plus 18,000. That should give me 19,700. All right. And that's that about that. Just for us to note, NCI is 19,700. Group retained earnings is 54,800. Goodwill on consolidation is 11,500. Now, we have only done one leg for this guy. And that one leg is to use that 1,500 to reduce the profit of ESCO, right? We still need to use it to reduce the non-current assets by crediting the non-current assets. So I said you will not, because on the day of your exam, you are not necessarily writing the double entry. Although if you want to explain, you may write it. It gives you even more confidence as you are doing it. Even the examiner too, we have confidence in you that this person knows what he is doing. All right. However, beyond that, the cocoa for me is that when you get to your consolidated statement of financial, when you are presenting it, you must ensure that you have removed that 1,500 from the non-current asset. That is the cocoa, because that's the only way you will get it. Even if you write the double entry, I don't remember to deduct it. The examiner will not say, I just got double entry. And sorry, I'm speaking to people who are not necessarily Yorubas. The person will say, the person will not say, and this person really got the double entry. It's just that, he or she must have forgotten to make that reduction. It will not earn you any mark. All right. If you know it, if you want to express yourself, express yourself. I don't have a problem with that. What I'm going to have a problem with is if you don't now remember to deduct it. Because one of the reasons why, as a student back in the days, I used to practice question is because I know myself, I can be forgetful. So what I do to conquer that forgetfulness is to solve and solve, so that when I have seen myself make such mistake, I will know that this is one mistake to look out for. When you get into the exam hall, ensure by all means that you don't make this mistake. All right, good. Now let's come back here. And I have all the questions. Okay, good. So what I'm going to do is I'm going to consolidate fully my PPE. However, this is where, what is it called now? This is where my adjustments are. First of all, this 14,000, I am to add 11,500 and then remove 1,500. I must not forget that. We debited non-current assets with 11,500 and then we credited non-current assets with 1,500. So I must do that one. Okay. So when I say PPE, my PPE will be 31,500 plus 14,000 plus 11,500 minus 1,500. Okay. 11,500 minus 1,500 is 10,000. If I add that 10,000 to 4, God bless you. 55,000 what?
500.
500. Mr. Latif said, no need to waste time. Investment in associate will not come here. As associate. In subsidiary will not come here. It has been cancelled out. And then we had a goodwill. Was it not 10.5 or 11.5?
Yes. 11.5.
11,500. All right. And then current assets. Our current asset is going to be 62,500 if I'm correct. So this way,
120,500.
120.
129.
Okay, 129,500. All right, and then we come here, ordinary shares. Ordinary shares of subsidiary, of parent, 40,000. Now the group retained earnings was it not 54 or how much? Is it 54,800?
54,800.
Yeah, 54,800. Together, this will give me 94,800. And then we're told NCI, when we calculated, was 19,700. I remember that one. Is this 114?
114,500.
Yeah. So my current liabilities is 15,000. I add all of this, I get 129,500. So it's as easy as that. Now, what are you likely? Okay, this should be clear. I think it's easy. I think it's easy as well. What am I to expect in the exam when it comes to statement of financial position? We'll look at that. I just want us to pick up associates. Once we pick up associates now, we are going to do questions together. Now, what should I look forward to? I should look forward to everything we have said. Because you're going to have questions that will test the first additional information, maybe testing something that has to do with acquisition during the year. You might have adjustments. You might have intra-group. You will have a lot of things there. So what we have done is to take it one by one, the different scenarios you can meet, before we now go into looking at everything mixed together. I feel like that is the best approach. That was the approach that I used to learn. I used to learn group how many years now, and it's so very fresh in my head. And even when it's not very fresh, it doesn't take me time to pick up whatever the conversation is. It's because the understanding on the principles bit by bit is very clear. All right. Okay, we may not go, I may not stretch the class too much, but then we'll still need to look at, okay, Mr. Latif, go ahead.
Well done, sir. Can you hear me, sir?
I can hear you.
Okay, thank you so much. I want to ask this question, sir. We have seen from your workings a scenario whereby the asset of the subsidiary was understated at the acquisition date. That is why it was added to the net asset of the subsidiary under our goodwill, to derive our goodwill. So can we have a scenario whereby it is the asset of the parent that will be understated?
Okay.
One. Number two, question that how can I recall that now? Okay, if I remember the second one, I'll get back to you.
Okay. All right. Could you have fair value adjustment for the parents Yes, you could have that. It's just fair value adjustment. Now, what it means is that expectedly, in the separate effects of the parent, that revaluation would have taken place. And then when I want to consolidate, I will consolidate the numbers. It's not so hard. What it means is this, for instance, it is the parent net, I say net, non-current asset that was revalued. The only thing is that any adjustment must not touch NCI because NCI does not have any problem with parent. For you to understand what I'm saying, parent would have said, oh, we did a fair value adjustment, increase in non-current assets, debit that, let's say it's 10,000, 11,500, do that. Then if it is the policy to credit OCI or to credit POL, 11.5. The implication of this, you would have increased your retained earnings. Abi? Fine. You go and treat that adjustment only for the parent. Do you get? Only for the parent. Will I consolidate this increase in PPE? Yes, I will. When I am doing my consolidated group retained earnings, this 11.5 will be under PICO solely. It is going to be under PICO. It will not go under ESCO because it is not to be shared between NCI and parent. Do you understand now? So the difference between what we have done now for these parents and what we did there is that the other time we said debit NCA, non-current asset, but credit the acquisition account so that you can use it to net off the consideration that was paid by the parent or by the acquirer. Do you understand the difference now? Instead of it going to P or L for parent, because for parent, it's
We can't hear you more anymore, sir. You know where your voice has run to again.
well, if you adjust anything for subsidiary and it is not all fully owned by the parent, then it will be split between the parent and the SCI. Go ahead, sir.
Okay, thank you, sir. Part of your example that we have seen is that we have seen a scenario whereby the asset of the subsidiary at the acquisition date was understated. We have seen that.
Okay.
What can we have a scenario whereby the asset of the subsidiary will be overstated at the acquisition, whereby during acquisition, whereby during consolidation we have to revert it back to what it should be?
Yes, that can as well happen. It's still fair value adjustment. It only means I am crediting PPE or non-current assets, all right? And then I am debiting acquisition account. This would rarely happen, but it can happen. It can happen. What it means is that I am still going to do the same thing. It's just that it will be the opposite sign now. Before, I added it to to the net asset acquired. This one now will be a reduction on the net asset acquired. That's straightforward as that. You see the same thing.
And depreciation will equally comes up in there.
Yeah, depreciation may come up. If depreciation come up, it means that there is a reduction in the depreciation, Abi. That reduction in the depreciation, you debit, you credit your retained earnings under subsidiary. Instead of 1,000 minus 1,005, it would have been plus 1,005. However, when you get to your consolidated statement of financial position, under PPE, instead of adding 11.5, you would have minus 11.5, then add 1.5. You know, the question we solve now, we plus 1.5, 11.5, yes, then minus 1.5. So it would have been the opposite. So it's possible. Okay. It's possible. It's possible.
Thank you, sir.
All right. You're welcome. All right. Let's quickly do accounting for investment in associate, IS 28. We may not solve real questions like that. I've seen the question to be solved. I've seen the real question to be solved, but let's just quickly look at it. What we want to learn, I don't want to waste our time. What we want to learn in terms of the calculation aspect of it is what is called equity accounting. And there's really no big deal to it. We have been doing something similar to it with how we have been accounting for NCI, in the sense that we add the portion of the profit of the subsidiary to the NCI, and then we take it as an element of equity. It's the same thing we are going to do for associates. The only thing is that the associate is not an equity line. It's not a line on the equity of the consolidated statement of financial position. Let's look at it quickly. Let's look at it quickly. All right. We know the type of investment. The rule for consolidation is that you should have over 50%, right? But we could have a case whereby your equity interest lies between 20% and 50%. When this happens, we say you have made an investment in associate, all right? You will be regarded as an associate, all right? Now, what the standard says, IS 28 says you should account for that investment in associate as equity, using equity method. You are not to consolidate per se. What we have been doing so far is that even though the parent does not own 100%, when we are doing the group account, we will add everything, assets and liabilities, we will add it together, line by line. But in this case, IS 28 says you are not to fully consolidate. What you should just do is simply called equity method. All right. Now we have exemptions from applying the equity method. I'm just going to quickly go through them. A parent need not present consolidated FS if and only if all the following holds. So it means these conditions, all of it must put. Now, it is not for you to go into the exam hall and put, I would like you to state categorically, if the question says, what are the exemptions from applying the equity method? That you put that clause there, that it is if and only if all these conditions are met, so that you can tie it together and you earn all your marks. Don't play. Don't give those 4 things and then you lose some marks because you were not very assertive in stating that all those conditions should be met before we can say, okay, you know what? You may exempt yourself from doing equity method. Number one, the parent itself is the only owned subsidiary, or it is a partially owned subsidiary of another entity, and the owner, including those not otherwise entitled to vote, have been informed about and do not object to the parent not presenting consolidated financial statements. All that English is to say, hey, as both controlling interest in B. All right? A now wants to say, I don't want to consolidate B. If that is the case, all right, I will only produce my separate financial statements. I have investment in C as well. I don't have controlling power in C. However, I have what is called significant influence, which means my investment is between 20 to 50%. All right. So ordinarily, I am supposed to consolidate the assets and liabilities of B, and then I'm supposed to use equity method to account for my investment in C. But I want to exempt myself. Why? Because I have a parent that either fully owns me or not. Let's call the parent PA. Now, this PA owns this A. This A is a parent to B and has significant influence, but is trying to say, I don't want to produce consolidated statement. If PA, which is the parent, the owners of this parent, agree to A not presenting a consolidated financial statement, that is the number one condition. Is this clear? If the owners of the parent here is A, but even A self gets parents, and the parent has not objected to it presenting not presenting a consolidated financial statement, then it is allowed. That's condition number one. Condition number two is that the securities of this parent here, must not be a security that is publicly traded, meaning that their shares is not sold at the securities exchange, meaning that it is not publicly quoted. What is the meaning of that? If I want to buy shares in Dangote, Dangote shares are traded on Nigeria's stock exchange. Why? Because it's a publicly traded company, it's a publicly quoted company, and they are fully registered with SEC. All right? But if I want to buy the shares of a company that is a private limited liability company, I cannot go to NGX because it's not going to be quoted there. For me to buy the shares, then I will have to do maybe private placement, or I will need to find a way to get it, but not publicly quoted. All right? So A must be a type of company that is not like Dangote. I can buy their shares. Now, it means that the level of public interest in this entity called A is not so high. So A can go ahead and do separate efforts, part of the condition, not just this one. The next one, it must also not be in the process of issuing securities in the public security market. Now, part of the condition, because what it means, why I'm going there is that you are a company. You want to sell your shares to members of the public. Then the members of the public must have access to know what is the financial affairs of that company. All right? And the one way they can easily know is through your published financial statement. So if you are in the process of issuing securities in the public securities market, you must give us all the information needed. You must consolidate and you must use equity method so that you can show us your investment in associates. Very important. But if you are not trading your securities in the publicly quoted exchange, you are not there, you are also not in the process, okay, with the first condition I have mentioned, but there's still one more. And this is the ultimate one. This is the last one. I said the ultimate or intermediate parent presents consolidated statements that comply with IFRS. Now, you remember the case of A here, where we said it must be that the owner of the parent company or part of the owners of the parent company have all come together and agreed that this parent company necessarily does not need to present a consolidated financial statement. All right? Should that be the case, even for that one to pass, it must be that this parent here, this owner of the parent, this PA, they produce a consolidated financial statement. So you can see it's really tough. It's really, really, really tough to have investment in associates, have investment in subsidiary, and then decide not to present a consolidated financial statement. It's really, really tough. It's really, really hard. You will not be a PIE. What do I call PIE? Public interest entity. You will not be a public interest entity, and then you must have the approval of your parent company. All right. Okay. All right. I am going to end it here. In the next class, we're going to go into calculations. I would very much love the next class to be tomorrow. However, I am going to be very busy. Okay. But then we'll come again next week, Tuesday. Next week, Tuesday, we are going to push the agenda. At least I want us to push the agenda to the point where we are going to cross this line. That was what I was checking for. All these questions are small questions. This one should not give us problem. Where we have simple consolidation with associates. I want us to come to this point where we begin to solve questions that have intra-group adjustments that involve associates. This shouldn't take us time. I believe that if our understanding is quick enough, we can round up on associates in the next class. And then we now have SOPL. SOPL should not take our time at all. Everything we have learned on SOFP is also in SOPL. Remember that some adjustments were going to consolidated retained earnings. Some of them, when you are doing a question that has SOPL, it just goes to the profit or loss instead of retained earnings. Okay, we are going to see that through, and once we are done with that, we have finished group accounts in terms of from this material. I will take up another special class for us to solve past question, maybe like 2 questions on that day, and then in another class we do another 2 questions. We are rounded up on that. The rest of the standards that I have with you, I believe with 6 classes, I can round them up. All right. Thank you very much for tonight. If you don't have any questions, I think we can draw the curtain here.